Hi, in this video you will learn how to analyze a company, a detailed business analysis of a company as enterprise, as industry, as financials, as valuation, and after that you will learn how to see technical chart pattern, and based on the technical chart pattern, if there is any buy call or not, all these things we will be discussing in this detailed analysis of a business. Myself, Dhiraj Mondal, a retired assistant professor and associate NCC officer, JIS College of Engineering and 2/49 Battalion Bengal, NCC Kolani. Currently I am a mutual fund distributor and serving my clients, and also founder Deepanti Wealth Management. So let's discuss today's detailed business analysis. I welcome to all of you to this session of detailed business analysis of a company named Relaxo Footwears. You know, all of you have heard this name, Relaxo. This company basically made slippers, shoes, sports shoes, mainly men's casual running shoes, walking shoes, sneakers, and you must have seen Akshay Kumar and Salman Khan. They are coming into the picture for advertisement. So we will be discussing about the company. Then we will be discussing the as enterprise, what about the company, then what about the industry, then governance, then financials of the company, then valuation, and after that we will be discussing the technical chart pattern. Based on the technical chart pattern, whether this company is value adding to your portfolio or not. So how to analyze a business, what are the different parameters you need to analyze, and based on the detailed analysis, how we can say that this company is undervalued and we should take a position on a company. This video is basically for learning purpose. There is no recommendation to buy and sell. You have to listen to me till the very end. Those who have not patience, please leave the class. So let us discuss about the Relaxo Footwear business. So first of all, introduction. Relaxo Footwear Limited is a Fortune 500 company and is largest manufacturer in country. Relaxo Footwear Limited incorporated in 1984. So this company has a 30 years of experience, market experience, and they are basically providing some brand like Relaxo, Sparks, Light and Bahamas, which is basically leading brand in its category, and this company is coming under the non-leather product category. Its raw material is rubber. So the canvas shoes, sports shoes, sandals, school shoes and other type of footwear they are basically producing. This company sells its product through retailers, through distributors, retail outlets, exports and e-commerce platform. And the company derived 95.7% from the domestic and 4.3% from overseas business as of financial year 2023. So these are the product you can see in the screen. What about the market position of the company? The company is the largest footwear manufacturing and is ranked among top 300 most valuable company in the India. If we are talking about the product portfolio, the company manufactures Hawaii rubber slippers, EVA and PU based slippers, sports shoes and sandals under its brand like Relaxo, Sparks, Flight and Bahamas. If we are talking about the distribution network, then we can see the company has a distribution network of 70,000 plus retailers, 650 distributors and 405 EBOs with availability on all major e-commerce portal like Amazon, Flipkart, Meesho, etc. Now a big question for you, what do you mean by EBOs? Please write down in the comment section the full form of EBOs. Then I am coming afterward. If we are talking about the geographical revenue bifurcation, then 45% of the revenue is coming from the north segment of the India and 25% from east. Whenever I am talking from north means most probably it is your UP, and if I am talking about the east then it is West Bengal. If I am talking about west then it is Maharashtra, and southern part, from west part it is 19% and from south part it is 11%. Why this percentage is less? Because VKC, another company, they are the competitor of this particular company in the south. It is also export 34 countries and has one overseas office in Dubai. The company has achieved a 3-star report export house status in FY24. So this was all about the geographical revenue bifurcation, and if I am talking about the revenue mix FY24 brand wise, then 38% revenue coming from the brand called Sparks, 37% is coming from Flight and 38% is coming from Relaxo or Bahamas. Let's talk about the channel wise revenue mix, that is your general trade 76%, modern trade 10%, retail 9% and export 5%. Let us discuss about the manufacturing facilities of the company. The company has 9 manufacturing facilities at Bahadurgarh coming under Haryana, Bhiwadi which is coming under Rajasthan and Haridwar which is coming under Uttarakhand, with a capacity to produce 10.5 lakh pairs per day, which is huge. That means 30 crore pair per annum. And it has introduced lean manufacturing, a dedicated line for manufacturing fast moving SKUs and the Maynard operation sequence technique most at its manufacturing locations. Now let us coming to the next point, that is your volume and realization. In FY24, the company sold 9.5 CR pair of footwear compared to 17.1 CR in FY23. You can see how the number of pair is increased, and if I am comparing with FY22 it is 17.5 CR. So the average realization per pair was rupees 148 in FY24 compared to 161 in FY23 and 150 in FY22. In Q1 FY25 it sold 5 CR pair at a realization of rupees 150. So we can see rupees 150 average price, and the company is selling a very large number of pairs, which is a very good sign for the company. Now why this company is falling like 73%? This company is falling from 52 week high, that is 1446, and right now the company is at 401. So why this company is basically falling? So we will be finding out what is the reason behind it, and whether this company is good enough to buy in at this price. We will be discussing all this. So let us discuss. So the main reason is basically margin issue. You know, the company sales is basically down. How we can see from the profit and loss statement? We can see the sales is basically down. You can see here quarterly result. So why this sales down? We will be discussing. So let us talk about the margin issue. The company operates in a labor intensive industry and faced profitability challenges in Q1 FY25 due to a mandated increase in minimum wages. So you know, in India there was some mandate, that means to increase the payment of the labor, that means labor wage. So company has to increase the payment of the labor, and also the raw material price was up, and company was trying to increase the price of the product, and as a result the sales was down. We will discuss. So management chose not to pass on this cost to consumers amid subdued market condition. To improve performance, the company is implementing cost optimization initiative this year. FY23 saw a dip in margin on account of raw material inflation. You know that in FY23 there was a inflation of raw material, crude oil price was increased. So basically the raw material price was increased due to that particular inflated number, which company basically absorbed, and the margin is in FY24 was boosted by subdued raw material price, however partially offset by increased fixed expenses. And another reason was capex. Company was trying to expand in the capital expenditure purpose, because company and some extra amount of area land is purchased and some extra factory they are setting up. So in FY23 and 24 the company incurred a capital expenditure of 174 CR and 232 CR respectively in FY financial year 23 and 24. In December 23 the company acquired a land of 30 acre for rupees 135 CR in Rajasthan, which will be used for setting up manufacturing facilities for future needs. So for capex purpose the company expenditure was increased. So we will see how it is reflected in the investing, that means the cash flow statement. We will see this is your cash flow statement, and you can see cash flow from investing activity. The company purchased some fixed asset, that is your 116 CR, 249 CR, 185 CR. So these are the basically cash flow statement, and investing activity we have seen this one, and always you know the investment purpose this particular things is coming negative. So these are the investment, and after this investment the operating cash flow is drastically increased, you can see here. So for the capex purpose the company invested some money. Why we are looking into this particular company? Because this company has some niche or some property right. It is called IPR, intellectual property right. As of FY24, the company had 87 registered trademarks and 12 copyrights and 1260 product design. So from this statement we can say the company is having some unique point, which is basically a positive sign. If we are talking about the new initiative, then in FY24 the company launched the Relaxo Parivar mobile application, a retail outreach program, and its first consumer experience store in Delhi. To help distributors drive secondary sales to retailers, the company has revamped its distribution management system. It is also expanding its e-commerce operations by directly selling to consumers using the brand as seller model on all major e-commerce platforms. So this company is basically received some awards. You can see list of the awards: CNBC TV 18, Dune and Bradstreet 2016 top 500 company in net profit, then again top 500 company in total income, ET 500 Fortune Ready company, ICRA safety rating, India's largest corporation 2016, India's most valuable company Business Today 2016 by market capitalization, India's most valuable company Business Today 2016 by net profit, the next 500 Fortune India, best corporate brands by the Economic Times, India's most valuable CEOs by Business World, India best corporate brand 2016 at the Economic Times Best Corporate Brand Summit, the first place at Council of Leather Export for excellent export performance during 2014-15, and so on. The MD Ramesh Kumar Dua has ranked among top 100 CEO by Business Today, and lots of awards you can see. What are the different brands? So we have also already discussed Relaxo, Sparks, Flight, Bahamas, Boston, Marizane, Kids Fun, Casuals. These are the different brands which are company providing to the nation as well as outside India. So what is the outlook? In FY25 the company is expecting double-digit revenue growth and EBITDA, that is earning before interest and tax, depreciation and amortization, margin of 15 to 16%. It will add 50 to 60 new EVOs in FY25. So this is all about the company overview, and now the time is to discuss about the enterprise, about the business overview. We will be discussing few points which is positive, then few points which are negative. Whenever we are going to discuss something, then there must be some positive information, there must be some negative points. So let us discuss about the positive as enterprise. So as an enterprise, what about the scenario of Relaxo Footwear? Let us discuss the positive points first. So first positive point is your Relaxo is one of the largest footwear manufacturer in India, primarily catering to mass market category. Under the IPR spectrum, they have 86 trademarks, already discussed, 10 copyrights and some designs. Most of their manufacturing operations are undertaken in-house rather than outsourcing. That means they are manufacturing by themselves. They are not outsourcing this part. You know that some company, they are basically outsourcing the task to the local manufacturer, and they are adding the tag like Sea Leathers. They are outsourcing the particular task to the local manufacturer, and they are putting the tag on them, on the product, and they are selling the product. Most of their manufacturing operations are undertaken in-house rather than outsourcing, which ensures better quality control. And it has 8 manufacturing facilities with a capacity to produce 10.5 lakh per day. You know that 10.5 lakh pair shoes per day they have the capacity. It's a huge capacity. Recently they have added a capacity of 50,000 pair per day in the relatively premium sports shoes or sandal segment. The current capacity of Sparks is 50,000 pair per day, which they are targeting to increase to 1 lakh pair per day. So the company is targeting some growth in their space. Why? Because the global scenario we will be discussing per capita, based on the per capita income where we are right now, and what is the global requirement per capita per head shoes or pairs, and as per and the Indian requirement right now, what is the average shoes we are using, that we will be discussing. The company sold around 17.1 CR pair in FY23 and has sold 14.5 CR volume during 9 month FY24. 9M FY24 means your month from the month of March to month of December. The 3 quarter we are quarter 1, quarter 2, quarter 3 and quarter 4 we are there are 4 quarters. So first 3 quarter we are considering. The first 3 quarter is called 9M FY24. Now next point, positive point as enterprise is strong brand with 389 exclusive brand outlet. So I asked you to write down in the comment section what is the full form of EBOs. So EBOs means exclusive brand outlets. So it has 389 outlet as of FY23. As per Q4 FY23 con calls, they stated that they would target to add 60 to 70 EBO each year going ahead. As of Q2 FY24, they have an overall 399 EBOs. But we will see that how this company failed to increase this particular EBO or outlets and how the problem arises in future. Strong distribution network spread across 70,000 retailers or MBOs and 650 distributors having pan-India presence. Their products are exported across 30 countries. So the company is exporting its product across 30 countries across the globe. Out of overall 70,000 plus retail outlets, Sparks is present in nearly 10,000 outlets, which would increase to nearly 15,000 to 18,000 outlets in next 3 to 4 years. Sparks is doing good in southern and western market. Now the company is focusing on doing the same in east and north. Next positive point as enterprise is revenue from EBOs contribute nearly 8 to 10% of the business. Next point, strengthening of distribution channel. A sharper product portfolio and strategic marketing investment aided them to achieve growth from exports, with exports revenue exceeding Indian rupees 100 crore. Next positive point, about 10% of their revenue contributes to 500 plus ASP. Open is to closed footwear mix stands at 82:20. Premium brands includes Bahamas, Flight and Sparks. And also the e-commerce contributes to extend 12% of the revenue. In Q3 FY24 press release, management hinted about continued challenge with respect to the demand in the market, to have direct connect with consumers and to control discounts. They have stated selling product on marketplaces at the company's website, and they are initiating direct connect program with multiple brand outlet by offering direct benefit to retailers, wherein all these initiatives are anticipated to improve performance going forward. So the marketing strategy they are improving, and they are basically coming to the end customer, that is retailer, to give maximum benefit. Now let us discuss about the negative point of as enterprise. Certain challenges faced by company include very competitive pricing and presence in the market, steep competition in the industry, exposure to commodity price volatility, and fluctuation in the exchange rate. So we can see there are very much competitor like Reebok, Adidas, Nike, lots of competitor in India also, Bata India, then Mirza International, you can see here the peer group, Metro Brands, Campus Activewear, Mayur. So lots of company they are the competitor. So company was trying to increase the price, then finally it was reduced because of the sales down and the competitor. So these are the challenges. Next negative point, the EBO count has declined. You can see from 398 to 387 from FY21 to FY23. So EBO also declined. Significantly, annual cash flow of approx 100 to 150 CR pertaining to capex is expected to continue to exert pressure on the free cash flow of the company. So for the new investment there was the pressure on free cash flow. Free cash flow as of FY20 and 21 are 203 CR and 390 CR respectively. Free cash flow as of FY22 and 23 was negative INR 84 CR and 216 CR respectively, and it is primarily for what? For maintenance capex, as they have 8 manufacturing unit. So for the capex purpose, capital expenditure purpose, the cash flow was seen negative. So that is the negative point as enterprise. The export contributes 8.4% only total revenue, and if total revenue is coming 100%, then only 4.3% revenue is coming from outside India. So very less export number. Next negative point, high revenue from northern geography and low from south and west. From south and west geography, from south and west region, revenue growth is very less. More focused on men's footwear. You can see they are basically for men's footwear, men's and kids, but women's section there are very less options. So that is also a challenges. Next, increased GST on footwear item costing MRP below INR 1000 has also impacted their volume sales, as most of their items sold are mass and value categories. So you know that recently you have seen that GST on footwear item is increased. So as a result the company's margin was also decreased. Most of the item ultimate consumer operates in mass market, wherein Relaxo experience price elasticity, therefore decline in volume impact margin and thereby the profitability of the company. What do you mean by price elasticity? Price elasticity means if the demand is basically decrease, that means decrease in demands as when they increase the price. That means if I am increasing my product the price, then automatically demand will be in decreasing order. So this is called price elasticity. Some company has the price brand value, based on that if they are increasing the product price, the price is also there is no effect because we are depending upon that particular product. But here you can see we have some alternatives. That is why this company price cannot increase in the different situation. It is depending upon the peer group. If they are increasing their price, then they can increase the price. So this is called price elasticity. I hope it is clear. Industry overview. So let us discuss about the positive note of industry overview. So the global footwear market size as of 2021 stood at USD 385.5 billion. So we are going to talk about the overall global scenario, global requirement as versus India. So total market is your 385.5 billion, which is expected to increase to 476.8 billion by 2025. So by 2025 we are expecting the global footwear market will be growing 476.8 billion USD, billion dollar. So globally per capita footwear consumption stands right now at 3.2 per pair, primarily driven by developed nation, where the per capita footwear consumption stands at 6.5. So here we are talking about the per capita footwear consumption. So globally per capita footwear consumption 3.2 per pair, primarily driven by developed nation, where the per capita footwear consumption stands at 6.5. Comparatively, India is relatively underpenetrated with per capita footwear consumption at only 1.9 per capita pair consumption in USA. In America it is 7.2. In China it is per capita footwear consumption is 2.9 and India is 1.9. So you can see India is underpenetrated country where the footwear consumption will be increased. India is the second largest footwear producer globally. The sector holds an important place in Make in India initiative and thus has been chosen as champion sector. Domestic manufacturing poised for growth in wake of decline in footwear imports. So these are the some positive points about the industry overview. As of FY22, Indian footwear market size stood at INR 930 billion, which is expected to grow INR 1415 crore by FY25. The growth rate expected is 15% to 17% CAGR from FY22 to FY25. In terms of revenue mix, in terms of mix, share of organized segment is seen improving from 31% to FY20 to 34% in FY22. The same is expected to reach 38% by FY25, thereby enabling higher growth for organized player in comparison to industry growth and other or unorganized players. Organized segment to report CAGR of 20 to 22% between FY22 to 25. Next point, drivers that are expected to drive the consumer demand includes rising disposable income, changing lifestyle and increase in literacy rate, rise of middle income group and millennial population, footwear evolution from being a mere necessity to an important fashion accessories, growing trend of premiumization in the Indian footwear industry and the shift to branded footwear. So these are the industry overview as positive side. Now negative side is high competition from global players like Reebok, Nike, Woodland, Adidas. In addition to international brands, there are also certain Indian footwear competitors such as VKC Group Footwear in southern India and also some other party like Bata India, Campus, Mayur, Metro brands and so on. So these are the competitor. Growth of online retailers might create pricing pressure and increase competition. So these are the negative points as industry. Now let us discuss about the governance overview, which is most concern from my point of view because there is some issue, but let us discuss the positive sign first of all, then we will be discussing the negative part. So positive is no share placed by promoter. How we can see? You can see from the screener.in this website. If you are searching here Relaxo Footwear, then you will be getting this company and you can see the place percentage 0 here. place percentage 0 means company is placing no share. That means sometime company is placing its own share and receiving some loan from the banks. So basically if some money is required for capex or other purpose, then sometime company is placing its own share. This is called loan on security. So it is placing 0% share, that is very good, healthy sign. Healthy promoter holding 71% as of December 23. You can see the investor profile here, 71.27% promoter holding here. So the maximum percentage of share is basically in strong hand or promoter in the hand of the promoter group. Increasing stake of domestic institutional investor, and it currently stands 8.86% as of December 23. You can see here DII, domestic institutional investor, SBI large and mid cap fund, SBI long term advantage fund. These basically funds are holding these particular stocks. So 10.55% of share is basically in the hand of DII, that is domestic institutional investor, and FII 3%. So there are mainly, you can see 85% share, it is in the strong hand. But if I am basically again look after this particular thing, then in the public you can see there is some HNI group. So 5.86 and 3, almost 9% share in the HNI hand. That means total out of 100% share, the retail investor is holding almost 6 to 7%, or you can say 5 plus 3 8 or 9. So 9%, 8 to 9% share is basically in the weak hand or public or retail investor they are basically holding. So 91% share is in the strong hand, DII, FII, promoter and HNI, high net worth individuals. So from this holding pattern, shareholding pattern, we can see the company is right now trading at 401. So there is some strong reason to go up the share price. Good employee and product review. This is also a positive governance. From governance overview, this is also a positive view. That means good employee and product reviews. Next point, company is having contingent liabilities of 7.71% as of March 2023, and earning quality ratio over the 6 year is 86% for the company, which falls within the ideal ranging 80% to 120%. This is the ideal range, 80 to 120% earning quality ratio, but company is having 6 years earning quality ratio is 86%, which is also a healthy sign. So these are the positive points as governance, but there are some negative point also as governance. So let us discuss about the negative points. So first negative point, low foreign institutional investors stake, that is 3% almost. That is also a bad sign. That means foreign investor is not looking into this stock, they are not finding any reason to enter into this stock right now. Very promoter driven company with promoter driven board, lack of succession planning is visible. As we can see, there is 71% share is in the promoter hand, and Ramesh Kumar Dua, he has 23% share, and very promoter driven company. And in the board meeting we can see the promoter group, that means the promoter is basically whatever the decision is taken by the promoter group only, independent decision is very less, we can see, and there is lack of succession planning is visible. Basically succession, who will be coming next, that particular thing is not transparent. So that is why this is a red sign also. very high salary drawn by both promoters. If you are see the company annual report or the con calls, whatever, if you are observing, then you will be seeing that the promoter Ramesh Dua and all the promoter group, they are basically withdrawing the high salary, which is not a good sign. Receivables have increased by 9%, whereas revenue increased by 7%. So there is some trade receivables and all this part. So it is basically not a good sign. That means the money is not coming into the company's hand, and revenue growth is 7% only, where they are targeting it is it is basically they will be taking it in double digit, but again it is very negative sign. Next point, audit fees of Relaxo have grown by 11%. It is also a very bad sign, because the audit fees is 11% and revenue growth is 7%. It is also something problematic as per my opinion. So it is basically some negative sign as governance, and this is only negative point. Rest of the points are positive as per my opinion. Let us discuss about the financials. Financial also was some negatives, but right now it is improved. So let us discuss this particular part, the financials. What are the positive point? Since FY 2009, revenue has increased by 14.7% CAGR, driven by 8.7% CAGR in volume and 9.6% growth in average price realization. PAT increased by 8.6% CAGR during the same period. Though the fixed asset turnover ratio has declined, but the total asset turnover ratio has increased primarily on account of improved net operating cycle from 181 days to as of 2022 to 114 days as of FY 23. So here basically from 2009 the revenue has increased by 14.7% and PAT increased 18.6% CAGR, compounded annual growth rate, and fixed asset turnover ratio also, has declined, but total asset turnover ratio has increased primarily. And basically what happened, the net operating cycle, it was 181 in FY financial year 22, but in financial year 23 it is 114 days. That is also a positive sign. Relatively debt free company. How we can consider this is debt free company? Because if I am observing the balance sheet, then borrowing is right now 213, that is 213 CR, and comparatively we can see the fixed asset, investment and other. You can see here inventory itself 558 CR. Trade receivables, it is 312. So trade receivables it is also, it will be coming to company's bank account, and also cash equivalent 42 CR. So if I am adding this particular part, then this 213 CR of borrowing is negligible. It can be eliminated by the help of this asset. And you can see these are the lease liabilities. That means company is basically have some lease liabilities. So this is almost negligible debt. So we can consider relatively debt free company. Very good point, very interesting point, and we can consider this point and as a strong point. And also free cash flow inflow of the company increased to INR 216 CR as of FY 23 as compared to free cash outflow as of FY 22 of INR 18 CR. So these are the free cash flow statement. It is basically, you can see from the cash flow statement, and you can see here from the cash flow statement there are 406 CR operating cash flow, which is basically a positive sign. That means company is receiving cash from the end customer. During Q2 FY 24, they posted revenue growth of 4.7% year on year and PAT growth of 28% year on year, indicating some signs of improvement. Also, gross profit margin have touched 57% during the quarter. Margin increased due to softening of raw material price and better operational efficiencies. Next positive point is volume grew 14.6% on a year-on-year basis, partly offset by average realization by 7.4% on a year-on-year basis. So these are the positive financial points. Next, negative financial points we will be discussing. There are two negative financial points. That is, during FY23, revenue increased by 4.1%, 9% year-on-year, volume degrowth of 2.1% and ASP growth of 7.1% year-on-year, but profit after tax declined by 33.36% year-on-year, primarily on account of liquidation of high cost inventory with the company. And also during FY23, they increased the prices of their products, which led to a decline in demand, post which they were forced to reduce the price again. So this was the point. Basically, they increased the product, then due to the sales demand, less sales demand, they again forced to reduce the price. And apart from that, impact of increase in GST rates and slowdown in rural demand has also led their sales to grow at slower pace during the year. All of these has caused their gross profit margin to decline from 54% in FY22 to 52% in FY23. So again, the negative point is the company was trying to increase their product price, but it was not sustained. The product sales was down. That means the sales down means profitability down, and also GST rate was increased, so margin was affected. Return on equity has declined from 13.2% in FY22 to 8.3% in FY23. The decline in ROE is primarily led by decline in PAT margin, that is profit after tax margin, reduced because of the reduced profitability and slight impact of deadline in fixed asset turnover ratio, that means reduced asset efficiencies. So this is the negative point of financials parameter. Next, let us discuss about the valuation. What is the status right now? The company is basically providing 0.75% of dividend. You can see from here. You can see 0.75% dividend is providing, the company is providing. Next point, it has a reasonable PE as of today. The current PE is your 58.8x as compared to 5-year median PE 103.2x. How we can see? We can see from here. This is your price chart, this is your PE. Click on this particular point, PE ratio. If I am clicking on 5-year, then you can see median PE is your 103.2, and right now company is trading at 58.8 PE. That means profit to earning ratio. So we can see this is your median 103, and company is trading below median PE, almost 50% discount price. And if I am observing the 3-year median PE, so this is your 105.8, and right now company is trading 58.8 PE. So it is also 3-year median PE, 5-year median PE, and also 10-year median PE below the 10-year median PE. So the company is trading at discount price. Let us talk about the 1-year median PE. 1-year median PE is 98. The company is trading 58.8. So the company is fair valued or undervalued based on the PE. Let us talk about the PB, profit to book value. So profit to book value, 3-year profit to book value is your 11.7, but company is trading at 4.8 book value. So it is also a positive sign. The company EV to EBITDA, you can compare from this point also. Company is a discount price, is in discount price. So these are the ratios and how we can analyze, I hope it is clear. So the company is undervalued and the investor can look into this particular stock for the P. If the P is re-rating, then company will trade in higher price in future. So one of the underlying reward of such low valuation is that the re-rating of P multiple may lead to improve the valuation significantly. If the P multiple is increased, you know what is P multiple? P means your profit to earning ratio. You can search in the Google also P ratio. So P ratio means your profit to earning ratio. So share price by earning per share. So if the P is increased, in this particular formula, if the P is increased and earning per share is increased, both of them, if either P or earning per share, if any of these increased, then share price will automatically increase. So if someone is valuing the share, then it will create some demand and share price will be automatically increased because of that particular demand. You can see the earning per share, EPS growth, all these thing in the quarterly result. You can see earning per share is automatically increased 1.33 to 2.26. So it is last quarter to this quarter, the EPS growth I can see here, and in the year-on-year basis it is 6.84. So as either EPS growth or PE multiple, so share price will automatically in the increasing order. So these are the valuation parameter. So market capitalization, financial ratios I have shown in the screener.in, this particular website. You can explore this particular screener.in. You can see all the financial ratios from here, stock, ROC, ROE and all this, PEG ratio. And quarterly result, we have seen that the company is right now 56 CR profit after tax. So from 37 CR to 56 CR, last from September 2024 to March 2025, it is consistently increasing its profit. That is a good sign. And also the operating profit margin is also increased from 12% to 16%. So overall we can see there is some growth of 69.7% profit growth we can see from last quarter. In the profit and loss statement, you can see company has a very good track record. In 2024 there was sales 1180 CR, and in 2025 or 24 it is your 1914. So there was huge sale. In 2022 it is 2653 CR. So we can see the sales growth almost 3 times, and the net profit is almost, we can see here, 4.5 times, from 66 CR to 170 CR. Profit before tax is 96 CR to 230 CR. So almost 4 to 5 times profit growth this company has given. So the company has a previous track record of 10 years of balance sheet I can see, and from the balance sheet we can see the company is almost debt free. Total 558, 312 and 42, that is your 912 crore is asset basically compared to this borrowing asset, that is your 2713. It is comparatively company is debt free, and you can see here the reserve is consistently increasing. Next point is your cash flow statement. Whenever there is some negative cash flow from operating activity, then just skip that particular company, because from the operation and from the sales the company is not receiving any money in the company's hand. So if the cash flow from operating activity is positive, then it is a good sign. Cash flow from investing activity is always negative, because you are investing some money on the business. Let's say you are purchasing some land or setting up some factory, then it is the cash is coming into the business from your account, so that is negative always. So cash flow from operating activity, it has to be positive. So company has a maximum cash flow from operation 406, and it is a very healthy sign, and based on this particular assumption we can invest this particular company based on our conviction. You can see the ratios also, debtors days, inventory, cash conversion cycle, but here ratios are not so good, but it is not nothing like some negative views here. So almost moderate view we can say here. Shareholding pattern, company is basically promoter driven and 91% share is basically holded by the promoters and strong hand there. Only 7% share are in the weak hand like retailers, and promoter DII, FII and HNI are holding 93% share. It means the strong hands are not willing to dilute the shares. Okay, now let us discuss about the technical analysis. So in the technical analysis you can see here this zone, this particular zone. Here you can see the multiple buying was done here in this particular zone. So what we have seen, lots of investor, they have invested their money in this particular region. So right now company is trading at 402 and it is down from almost 73% down from the lifetime high. If I am assuming there is some P re-rating or earning growth EPS, then the company can be trading at higher price, and if it is again coming to its maximum, that means lifetime high, then it will be a 259% gain. And if it is coming within 5 years, so what's wrong? Currently you can see there is some lots of buying zone here, and lots of investors, they are basically their cost price is in this region like 830, 850. So from this current price we can expect a 100% gain from current market price, and we can target this company as 807 rupees, 807, and it can be achieved within a maximum 3 years as per my viewpoint. But we cannot predict all this, but only based on the technical chart, technical parameter, the medium to long term target is your almost 70% like this, and long term target is your 100%, and lifetime target is your 250%, 259%. So if we have understood the company business, financials and all the parameter, then if we have some conviction, then only we can invest here. Right now the company is trading at 401, and 100% gain within less than 3 years can be achievable as per the technical chart analysis. So what we can conclude from here, as per the overall business analysis, we can conclude the company was facing some business issue, and as a result we have observed the quarterly sales of the product was down from the March 24 by 747 CR to December 24 by 667 CR, but recent quarterly result showing sales of 695 CR, which is improved by 4.2%, and operating profit margin increased by 16% from previous quarter, and it is also observed the net profit of the product was down from March 2024 by 61 CR to December 2024 by 33 CR, but recent quarterly result showing net profit of 56 CR, which is improved by 69.7% from previous quarter. Hence we are expecting 100% gain from current market price of 402 within a maximum 3 years time period. Let us discuss about the ratings. So if you are searching this company, then the NSE code is your Relaxo and BSE code is your 530517. Rating is 8.4 out of 10. Sector is leather, small cap category company, Today's date is 11th May 2025, and business or company, it is 9 out of 10, industry parameter 9 out of 10, governance parameter 7 out of 10, financial parameter right now 8 out of 10, and valuation is 9 out of 10. But before investing this particular thing, we should know these particular 6 points. Never invest more than 5% of net worth in any single stocks. Don't invest money in equity market which is required within 3 years. Don't invest borrowed money in the equity market. Don't invest money based on tips. Don't invest a single rupee if you are unable to understand the business and you have not conviction on that particular business. There is always a risk of capital erosion in the capital market, and we should be ready to face those circumstances. So portfolio diversification is always advisable. This analysis is done by Dhiraj Mondal, Assistant Professor, JIS College of Engineering, and also a mutual fund distributor and founder, Deepanti Wealth Management. This is my email ID. If you have any question, any confusion, you can write me in this email ID or you can WhatsApp me. All this information is sourced by charts and financial data is taken from Skinner.in and invest in Yadna Academy, and the chart is analyzed from the tradingview.com. These are the disclaimer. No buy and sell recommendation of this product. It is strictly for educational purpose, and all these disclaimer you can read accordingly. Thank you. If you have any doubt, any question, you can write in the comment section. I will be analyzing all these points. I will be discussing your query in another session. Today up to this. Thank you. So what about my analysis? If it is added some value in your life, then don't forget to subscribe my channel Dhiraj Mondal and share it with your friends, family, and press the bell icon to get everyday notification, and also follow me in Twitter, so get everyday real-time update. There is no recommendation to buy and sell of any product. It is only for educational purpose. Please take advice from your financial advisor. Thank you.